Today, is a rate cut closer now in Australia? Hello again, it's Martin North from Digital Finance Analytics Web. Now, this post covering finance and property news. The latest monthly CPI data for November 2024 was released today, and while the headline rate rose, the important trimmed mean figure, which the RBA tracks, did slip, despite still being above the top of the central bank's target band. The closely watched trim mean core measure, which smooths out volatile items and is the focus of the Reserve Bank, slowed to 3.2% from 3.5% in the prior month. That's according to the data from the ABS. Now, economists do expect the RBA's next move would be to ease rates, although they're still divided on the timing, given the somewhat sticky core inflation and uncertain global backdrop. Yes, so we are closer to rate cuts than yesterday, obviously, but a complete suite of price data for the December quarter will be released later this month, and that'll be important input into the RBA's February 17th and 18th meeting. The RBA has kept rates unchanged since November 2023 and has been highlighting that aggregate demand still exceeds the economy's supply capacity. In fact, minutes of the December meeting show the central bank is more confident that inflation is moving sustainably back towards target, but it's still too soon to conclude the battle is won. Members had noted that additional information on jobs, inflation and consumption, along with the revised set of staff forecasts, would be available by the February meeting, suggesting that next month's review could well be live. But money markets have priced in about a 70% chance of a 25 basis point reduction in the benchmark target rate in February, from a 13-year high of 4.35%. That's up from 61% before the release of the monthly CPI data. And they're also fully pricing in a rate cut by April. A reduction, of course, will depend on the data, as we've said. The Australian dollar fell to 62.23 US cents after the data from 62.4 prior, and the yield on policy-sensitive two-year government notes declined too, while the benchmark ASX 200 swung to gains. So perhaps the chances of the Albanese government getting a pre-election boost from a February rate cut has risen, and Treasurer Jim Chalmers said inflation had been at the lower end of the RBA's 2 to 3% target band for 3 months in a row, and unusually referred 3 times to bond market forecasts for a pre-election cash rate cut during a press conference in a potential sign of the government's growing expectations for mortgage relief. But of course, those rates are impacted by government support, so to an extent are a bit artificial. Separate releases from the IBS also show that job vacancies rose 4.2% in November. That's the first increase since May 2022. And overall, the economy and the jobs market still looks pretty strong. Economists at Macquarie Bank brought forward their rate cut prediction to February from May and said that there will be another 2 rate cuts to follow this year. The slowing in domestic market service inflation will also provide the RBA with additional comfort, they said. And NAB senior economist Taylor Nugent said the monthly figures showed inflation was more benign than in the RBA's most recent set of economic forecasts in November. Inflation is not a barrier for cuts, but conditions in the labour market are not creating much urgency, while the RBA's forecast for an acceleration in activity growth remains intact, Nugent said. And of course, the weak Aussie and the predicted larger government deficits are barriers to rate cuts, as I discussed recently. So, whilst there may be a symbolic rate cut before May, those expecting significant cuts this year should bear in mind the latest Fed vibe, which is in fact perhaps for only 1 cut in 2025 for US rates. RBC chief economist Su Long Ong said the door had opened to a February rate cut. However, she said the RBA would be hesitant to cut that soon, given the still tight jobs market, the prospect of extra spending in the lead up to the federal election, and the uncertainty posed by the incoming Trump administration. Exactly. Asked on Wednesday whether he would take responsibility if no rate cut emerged before the election, Mr. Albanese said the RBA was responsible for setting interest rates, and he also rejected assertions that increased government spending on the care economy, infrastructure and the public services was making the RBA's job harder. Well, he would say that, wouldn't he? Looking at detail, the monthly consumer price index rose 2.3% in the 12 months to November 2024. That's up from 2.1% in the 12 months to October. The largest contributors to the annual movement were food and non-alcoholic beverages, up 2.9%, alcohol and tobacco, up 6.7%, and recreation and culture, up 3.2%. Partially offsetting the rise in the CPI were annual falls in electricity, down 21.5%, and automotive fuels, down 10.2%. The ABS said annual CPI inflation has risen since last month, in part due to the timing of electricity rebates. In some states and territories, households received 2 rebate payments in October in lieu of not receiving a payment in July. From November, most households received 1 payment. As a result, electricity prices fell 21.5% in the 12 months to November, compared to a fall of 35.6% in October. When prices for some items change significantly, measures of underlying inflation like the annual trimmed mean and CPI excluding volatile items and holiday travel can perhaps give more insights into how inflation is trending. Annual trimmed mean inflation was 3.2% in November, down from 3.5% in October, the ABS said. Trimmed annual mean inflation remains higher than CPI inflation as it removes the large price falls for electricity and automotive fuel. The CPI excluding volatile items and holiday travel rose 2.8% in the 12 months to November, compared to a 2.4% rise in the 12 months to October. And the increase in the annual movement is primarily due to changes in electricity prices. The housing group rose 1.2% in the 12 months to November, up from 0.2% in October. Most of this change in the house price group was again caused by the timing of payments for electricity rebates. Electricity rebates lower the price of electricity for households. The impact of the rebates was lower in November than October due to the timing of payments. Excluding all Commonwealth and state government rebates, though, electricity would have fallen 1.7% in the 12 months to November, so you can see how artificial all these numbers are. Rents rose 6.6% in the 12 months to November, following a similar annual rise of 6.7% in October, reflecting a new tight rental markets across the country, which cuts across those who were thinking that rental demand was easing and therefore rental price growth was falling back too. New dwelling prices rose slowly to 2.8% in the 12 months to November. That followed a 4.2% rise in the 12 months to October. And annual new dwellings inflation is now the lowest since July 2021, mainly due to builders offering discounts and promotional offers to entice businesses. Automotive fuel prices fell 10.2% in the 12 months to November, following an annual fall of 11.5% in October. Fuel prices have fallen over the past year as lower global demand has pushed down the price of oil. In monthly terms, fuel prices rose 0.9% in November, which was the first increase in prices since June 2024. Of course, with the low exchange rate, you have to expect oil prices to be higher ahead, and in fact, international oil prices are also higher now as well. Food and non-alcoholic beverages prices rose 2.9% in the 12 months of November, softer than the 3.3% annual rise in October. And the November annual movement for food and non-alcoholic beverages is the lowest since January 2022. Fruit and vegetable prices rose 6% in the 12 months to November, compared to a rise of 8.5% in the 12 months to October. While prices remain higher compared to 12 months ago, in recent months prices have fallen for tomatoes, cucumbers, beans, mangoes and strawberries due to favourable growing conditions. So the bottom line is this: you really can't take much out of this data at all. There are lots of moving parts and another set of data coming next month before the RBA meets. So, to my mind, the prospect of rate cuts is still a bit of a mirage. There's a lot more data to come and more water to go under the bridge before we see what the RBA does in February. And as I say, the exchange rate will potentially be a brake on rate cuts sooner rather than later. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.